Hi, I'm James from Maddisons Residential, and I'm delighted this morning to be joined by Jack Sales of TN Accountancy. Following the recent turmoil over the last few weeks and the mini budget that then turned out to be anything but a mini budget and caused complete grief amongst the markets and has been subsequently very rapidly reversed, we thought it'd be worthwhile sitting down with Jack and just getting a better grip on what's happening in the world of tax in relation to property. So Jack, welcome. Thank you for joining me.
Thanks for having me.
So Jack, let's start by that mini budget. Now, we've seen Jeremy Hunt being instated as Chancellor. We've now seen Rishi Sunak becoming Prime Minister, and he's now got his new cabinet around him. From the Chancellor's perspective, Mr Hunt did seemingly undo everything that Mr Kwarteng prior to him had put into place. Am I correct? Stamp duty, remind me where we are on stamp duty and who it benefits.
Yeah. So yeah, as you say, a huge number of changes in the mini budget, almost all of which have been reversed. From a tax perspective, only two areas have been untouched from that mini budget. So one being national insurance and the other being the changes to stamp duty. So basically the current rules, if you like, for non-first time buyers, so people buying their second or third or fourth or fifth homes. Under current rules, the first £125,000 of a property value is subject to 0% stamp duty. That's being doubled to 250,000. And for first-time buyers, that 0% band was 300,000. So the first 300,000 was not subject to stamp duty. That's being increased to 425,000 when a first-time buyer is buying a property of a value up to 620,000. So that there are some changes that are coming in with stamp duty. I think they are. I assume they have been kept because the government deemed them to be fair. I think really because it just represents the fact that property values have gone up so much since the original stamp duty legislation was written, and it's just a bit more akin to the current market.
Okay. Now, certainly from my role within Maddisons on the letting side of things, there have been legislative changes, taxation changes. One of which went through during lockdown in terms of changing capital gains tax. Now, obviously, we communicated that out at the time, but I've heard stories of people being caught out by that. Could you just perhaps remind us what changed a couple of years ago and the significance of it? Yeah,
so there were two main kind of changes, if you like, to capital gains tax from April 2020, so just as COVID happened. One part of it was just a tweaking of how capital gains tax is calculated, but we won't kind of go into that now. The main thing, and this is the thing that has been catching some people out, is that once upon a time, it used to be the case that if you sold a property and you have to pay tax on it, so this is generally someone who has a second home, an additional property of some sort. If you have to pay tax on it, you just report that's the property sale in your self-assessment tax return and pay the tax by the 31st of January that tax return is due. As part of these changes, basically, if there's any tax to pay, you are required to report the capital gains tax or the sale of the property to HMRC within 60 days of the completion of the sale, and that's done via an online return specifically with HMRC, and also pay the tax due at the same time. So there's been this huge acceleration of the reporting and payment of capital gains tax on property, from potentially being over a year from when the property was sold to being 2 months. So that there's this additional reporting requirement that HMRC didn't advertise very well, and we've had so many clients come to us and say, "Oh, I've sold a property 3-4 months ago, and I've only just heard about this."
Presumably, it's some sort of penalty system that if you haven't done it.
There are, yeah. HMRC had a bit of a soft landing approach. You know, they understood people didn't know about it. I mean, it's been in place for 2.5 years now. So, yeah, if people are sort of missing that, HMRC are within their rights to charge penalties. But it's just a case of, if you're selling a property, just make sure you're aware of any tax that you need to report, because you might need to potentially report it within a couple of months of the property sale.
I think that's absolutely key, isn't it? And we recorded a piece recently on accidental landlords, and this is where people have perhaps moved away from their main house to take a job elsewhere. Most often we've seen actually is going overseas, and obviously there are different rules that you need to be aware of for taxations for that. Or maybe they've not been able to sell their property, or they've moved in with a new partner and therefore rented the property out. There are certain things that those accidental landlords ought to be aware of as well, aren't there, in terms of reporting income on the property and reliefs and so on. So
yeah, absolutely. So with property that's held by individuals, I guess the key thing really is, I mean, people should always be doing a self-assessment tax return to report their rental income and pay any tax on that due to HMRC. People that have been landlords for a long time will remember a time when you used to get full relief for your mortgage interest. So that was, the mortgage interest was just treated as any other tax deductible expense from the rental income. About 5 years ago, HMRC introduced some legislation that basically restricts the tax relief on mortgage interest.
Okay.
And the upshot of that is, if you're a higher rate taxpayer, you don't get that much tax relief on your mortgage interest. So there's been a lot of noise in my industry about ways of trying to get around that. So one is actually having rental property in a limited company, because they're not subject to the same relief. The issue is, if you've got a property already, there's potential tax charges moving a property into a company. So that's it can work for some people, but it depends very much on individual circumstances, and people should definitely take advice on that. The other potential way around things is if a rental property qualifies as a furnished holiday let, and there's some specific conditions for that to apply. That's a term defined by HMRC, but that, broadly speaking, that's more akin to an Airbnb type property. And there is a way of effectively getting full tax relief on your mortgage interest if it's a furnished holiday let. So it could be a more tax efficient way of running a property.
We've got this statement that's been announced in the last 48 hours that the auto sector has been pushed back to the 17th of November. Michael Gove has been installed as the housing minister. Do you anticipate much on property?
From a tax perspective, it's difficult to say. It's always difficult to say if you just don't know what's going to happen. I would be surprised if there was too much going on. The mini budget that happened, there were a huge number of changes, and look at the turmoil that was kind of created in its wake. I think the current establishment, the messaging coming from them is very much we need stability.
Yeah.
So I would be surprised if there was too much going on, but in present times, who knows?
Yeah. Well, if there is, we will certainly tell you here, and we hope that's been useful. It's a bit of a snapshot, but if you have any questions at all, don't hesitate to get in contact with us, either here at Maddisons, or if it's of a sort of specific tax nature, we will refer you straight on to Jack. But thanks for watching, and all the best.